Hey everyone, welcome to the Mike Rosehart Show, live again, like we go every single Wednesday around 7 p.m. Eastern. So today we are talking about, what are we talking about today? Give me liberty or give me the Rona. No, I'm kidding. I thought about that as a title. I was sitting here getting ready to go live, and I thought to myself, no, that's a little too much. But I was watching an interesting podcast, I guess it was today, about just that, about Jordan Belfort's went on there, and he was talking about how it's just some crazy stuff about how people like are going paddleboarding by themselves and getting ticketed like $800, while people are at the same time lining up. Hundreds of people are lining up at the LCBO and at Costco, and just ridiculous that like one guy in a park is getting fined, or like two friends getting together are getting fined by the police. But then at the same time there's like large groups of people at the grocery store like all in line. Just silliness. I'm of the belief that we should have the freedom to choose. And today's Will It Be Enough is supposed to be about your retirement portfolio, having enough to retire, how much you need to retire, and then will it be enough in the new world that we're living in, right? And is it enough to carry on? Like, do we have enough? That was the point of this video today, and then obviously the Q&A that we always do. But yeah, I was kind of just thinking to myself, like, how crazy is it that we live in a state, in a world right now where people are literally having their freedom taken away from them? You should have the right to choose whether or not you want to go out and potentially expose yourself to, whatever viruses in the world. And like, I don't have a ton of data or whatever, but from what I can see, this virus is less dangerous than, like pneumonia and the flu and the other things that are killing people at similar rates, or like child poverty, et cetera, and so forth. But we don't do anything about that. Like, when tens of thousands of people die from pneumonia every year, I think it was reading stats like 4,000 or 5,000 a week in the high season, consistently every week in the United States die from pneumonia. But we're not on like every single news channel and shut down everything economically because 100,000 people died of pneumonia, which happens like every year. It's just crazy to me that we have such a lockdown that we do. I think that there should be forced, I think the way they went about it was wrong. I think there should have been like a forced, masks, forced like sanitation stations before you go in, before you leave, better hygiene in general. If people all were wearing masks and want to catch the virus, you're wearing masks and you wash your hands before and after. Whenever you go to a store, you can't, like, the air you're breathing is fresh in your mask, if you have a proper mask. And if you're washing your hands, precautions, and did a bit of social distancing, the economy could have continued on. We now have trillions potentially in economic loss over this. It was a terrible financial decision. I think there was other things at work here that sort of warranted the decisions that not all countries did the lockdown. Not all countries handled things in the same way, right? As the United States did, in Canada and Italy and so forth. But there's definitely ways we could have improved. But yeah, anyway, that was just my rant. I got to get that out here. And the other thing is, like, will it be enough? Talking about like our retirement portfolios, and we know that we relied on the 4% rule for forever. So us in the FIRE community, we've relied on the fact that no matter what, with absolute certainty, you can withdraw 4% from your portfolio indefinitely. So if you have $1 million, you can withdraw $40,000 a year in perpetuity and never deplete the principal. That's based on a study done by Trinity College that looked through all the economic data through 2008 crash, 2000 crash, late 80s, the 90s crashes. We've had oil crisis in the 70s. There's been crashes every decade since, forever. But again, in this quarter, it's the worst crash we've ever seen because economically everything's come to a halt. So GDP is going to be way down. Like, it's bad. If you look with a myopic view of like 1 or 2 quarters, it's really, really bad right now. Economically speaking, it's really, really bad. I'm personally taking losses on like any of my short-term rental stuff, my Airbnb stuff. Like, it's short-term bad. But macro, like when we look back and think the last 5 years in real estate, we've all made so much money. In the stock market, we've made the last 10 years so much money. That's like, we made, tens, hundreds of thousands, millions, billions, trillions. We should be thankful we've made so much, and not all those gains have been eroded. And if we were smart about things and you saved for the future, you're going to be okay right now. So my hope is that people were listening to FIRE before and were listening to the movement before, right? And that's important because At the end of the day, you have to think, if we get to a position, or we get to, this goes on another 3-6 months, I don't know how long this is going to go on, you're going to really need to have subscribed to the FIRE movement. I think going forward, a new normal is we're going to have to be financially smart with how we budget. And I think the government probably needed interest rates to fall in order to service their debt. So there's a piece there of like wanting interest rates to stay low, and I think in perpetuity they will stay low, at least for the near to midterm, definitely. So anyway, that was sort of my little rant there. I didn't really prepare at all for today. I just sort of was thinking about what I would talk about, and I thought, oh well, I'll put it up here. I'll talk about like our retirement portfolios. Is it enough? People are worried about like having to go back to work. I got a few messages about that, being like, hey, I was so close to financial independence. I was so close to that 4% safe withdrawal rate number. I had 25 years living expenses set aside, which is the number you need to know if you can actually retire. There are people who take the risk, and with businesses or with real estate, they get much higher rates of return, and so they live on their cash flow, and they basically run it like a business and survive off of that. That's a version of FIRE, but it's not really FIRE. It's sort of like a more aggressive, less conservative approach to FIRE, and you can there's lots of ways to retire early, and the financial independence retire early movement includes those people too, I think. But at the end of the day, like if you're a 4% safe withdrawal rate, you're totally good. Even in this market, we know the data suggests that through all recessions, there'll be a full recovery in like 3-4 years. So I think it'll be even quicker rebound with this specific situation. So I think a year from now, it'll be totally fine. My forecasts for real estate are short-term bearish, especially in markets like, if you're in a market where or in a segment of your market that does short-term rental, or is it all tied to tourism, or anything affected by COVID directly, yeah, there's going to be some really good buying opportunities. Definitely. I think that in Orlando, for instance, as just one example, it's a very touristy area. The governor shut down, it's illegal right now. There's a ban on it. So if you have any short-term rental business going on in Orlando, Florida right now, it's not allowed. So that's kind of like any owner who was on the edge of like being able to afford their mortgage, they're probably going to default, or they're probably, if they're not defaulting, at least they're in a position where they want to sell. And so I'm excited about those opportunities. I'm excited about that kind of stuff, and that gets me going. It gets me excited. And same here in London. Those people who are doing the short-term rental thing, there's still some opportunity there. Crazy enough, our real estate market is still hot. There's not enough supply. No one wants to list their house during this COVID epidemic, and people still want to buy. So there's an increase in demand to supply, which is crazy. You'd think prices would be dropping, but they're not. Real estate prices are holding strong. People aren't leaving. Like London, Ontario, Canada is still a great place to live. No one's leaving. So there's no decrease in demand. All the builders are frozen. They can't build right now. There's a stop order on all the builds. So there's no new construction. So no increase in supply. No one can renovate properties to add bedrooms or add units. So there's no increase in supply at all. No one wants to list right now because it's the middle of COVID. Who wants to have people come through their house, right, and do like showings and stuff? And who wants to go into a house that's tenanted? Because what if the tenants have COVID? So there's a really low supply, and interestingly, demand hasn't subsided as much as you might think because of a few catalyst factors like interest rates being the lowest they've ever been. I just locked in a 1.34% 5-year variable. Yes, I'm going to sign the paperwork tomorrow. I'm super excited about a 1.34 5-year variable rate mortgage. Ridiculous, like cheap, almost free money because of where the overnight lending rate is right now. So it's that type of catalyst keeps investors like myself who, a lot of the investors who have been sitting on the sidelines looking for a deal, we still have cash. We still have assets. We haven't lost that much. And a lot of people who had the stock crash in the first few weeks, we've seen a lot of recovery in the last couple of weeks. So people are feeling more bullish again, right? And so it's definitely a catalyst, I think, for the market. So yeah, 1.34 is disgustingly cheap. I was actually in shock when I saw the rate. I was like, is that real? Did I just get prime minus like 1.12% or something? That's insane. And yes, I did. And it's interesting, the banks haven't passed on all the Bank of Canada hikes yet, and I don't think they will, to be honest. But it's interesting that like there's still room that they could go further. Okay. Hey Gabe, how you doing? Hey Little Pump. Hey Ellie. Hey William. Happy Wise Wealth Wednesday. Hey, good to see you guys on. Sorry the title wasn't more engaging, but like, will it be enough is just to the idea that it may or may not be enough in your retirement portfolio. And if you're planning to retire this year, it might not be the time to do it right now. It might be prudent to keep your job just a little bit longer to qualify for some extra mortgages, to put a little bit more savings in nest egg. So you can take advantage of the discount on stocks and the discount potentially in real estate in certain segments, specifically people who are doing short-term rentals and things like that. So definitely that was the title of today's video. I didn't think of anything beyond that. It's going to be like an open Q&A. I'll end it early if people don't have a lot of questions, because to be honest, it's looking really nice out. My dog's running in the backyard and my kids are playing back there. It's not that warm out today, but I'd love to get out there and hang out too. So maybe we'll wrap up a short one. We've done a lot of long Wise Wealth Wednesdays, so we'll see what the audience thinks. We'll see what everyone's feeling today. Anthony says, nice. Hey, how you doing? Good to see you too, Bullet. Lindsay says, hey bro, good news. We have toilet paper again in Australia. Well, a wee bit. The selection is not awesome. Only 3 flavors, all in 9 packs. There you go. So the toilet paper crisis has been averted, I guess, in Australia. I still don't get the toilet paper crisis. I get like stocking food and things like that, but toilet paper is like non-essential. Just get in the shower, like worst case scenario. Best careers for real estate. So top 6, good capital and knowledge. I don't know what your question is. So I guess the first part of that is what are the best careers in real estate? Typically, the best careers in any business, if you have the skills for it, are sales, because you have no cap on your earnings. I used to know sales guys in the tech field that make $200,000, $300,000 a year because they were that good at selling, right? They'd make more than sometimes the CEO of the company because the sales guy was that good, right? Same is true in real estate. If you're good you have good people skills, you're good at talking to people, you're good at making connections, I think the best salespeople are very ethical and very intelligent. It's a myth that like the snake oil salesman does really well, because what you'll end up finding is that the snake oil salesman does well for a little while, but doesn't do well for the long term. If you're good at developing relationships and you truly do provide value, going into sales is a fantastic way to make a lot of money, especially in real estate. If you're selling like $500,000 houses with say 4% commissions, and you say you're doubling in the deal because you're actually good and you actually sell the house, that's 20 grand commission check, right, on each one you sell. So if you sold like 6 of those in a year, there's 120 grand. So it's very easy to make money in real estate sales, for sure. And the best thing about real estate sales is when you have connection to the deal, guess what? You start getting connected to the investors with the money. And as the real estate salesperson who puts that together, the most important thing is that most good real estate agents become good real estate investors, most that I've met. They start finding off-market deals, they start flipping, they start joint venture partnering with the capital partners that they meet. So being a real estate agent allows you to meet people with capital and allows you to meet a lot of people who are doing the things you want to be doing, and allows you to basically link up with deals. And once you control the deal flow and you know the investors, you can put the two together. So being an agent gives you a huge edge. Same is true for being a mortgage broker, which is again like very much a sales type job, commission-based job. Yeah, there's lots of other jobs you could take in the field. Some people have like, I took my LSAT and thought about becoming a real estate lawyer. Glad I didn't, because I think it wouldn't have added a whole ton of value at all. I haven't met a lot of good real estate lawyers who did well in real estate specifically. Not to throw any shade, like there's tons of great real estate lawyers, but they tend, when you're on that side of the transaction, you tend to be looking at like all the lawsuits and all the negative, and it keeps you out of going into real estate. So I think maybe that's not a great field to go into. But depends on your goals and your interests. That's the truth. But yeah, if you can get into sales, you can get into the side of like even, I don't want to say property management, because you probably get discouraged when you see all the bad tenants and not paying rent, and you see all the negative side of it. Property management's the worst. Like you just deal with tenants all day long. You're always in property management, you're dealing with the problems. So you're dealing with the tenants who have to go to the landlord tenant board, the tenants who trash the unit. You're dealing with, the tenants who didn't pay rent. Those are the ones that consume your time as a property manager. So going into property management, you'll probably see the worst in real estate, and it might discourage you. But if you could see, the best in real estate, then it would be able to give you a chance to be optimistic about it. Because I truly do believe you can make a lot of money as a real estate investor. Okay. Yeah, stock market's on fire this week. Yep, that is I think true of most of the stocks I've been looking at. AACI real estate appraisal or real estate attorney or real estate broker are working a REIT or something that's easy and provides decent income. So top 6, yeah, I think we covered a lot of those things. I mean, appraisers, yeah, being a real estate appraiser could be valuable because you'd be able to understand, how the people come to value property. That would definitely be something that would be valuable. I think real estate agent is probably the best way, or broker is the best way to, specifically agent, because you deal more with the client side. You deal more with, as a broker, you're dealing more with managing the agents and managing and that sort of thing. So I guess it depends on the type of broker you are, but definitely I would say that on the agent side, dealing with the client and with the deal, you learn a lot more being in the field like that, and you build better connections if you take time to really look at the deal analysis and really understand the deals that you're doing, and don't just work on like getting a quick commission check. What all world ETFs can you buy in Canadian dollars that focus on dividends? I don't know. I'm sure you could just do a Google search on that. That would reveal a ton of that. I don't know why you'd be focused just on Canadian dollars though. I guess if you're looking, I can see your point. If you're looking for, so on one side you want to diversify, right? You want to be part of as many different markets and as many different stocks from as many different exchanges as you can, because you have more diversity, right? And diversity is important. If the Canadian dollar tanks or something happens, you're protected. On the other side though, Canadian eligible dividends are tax preferred. And so I can understand there are a few funds out there, I'm sure, like I'm absolutely sure I could do a Google search real quick and find some that are designed specifically for the Canadian eligible dividend. And then you could, get that gross up tax credit if you're a Canadian citizen. Hey, Jason. Hey, Brandon. Should I buy bank stocks or SPHD? I don't know what SPHD is, to be honest with you. I'd have to Google that. My whole world consists of like managing whatever I got going on with real estate and helping the mentees and stuff like that. So I can look that up for you. I got my laptop here, so let me just fire it up and take a quick look of what that even means. SPHD. Invesco Exchange S&P 500 high dividend. It has a yield of 3.99%. It is trading at 31.53 USD. So I don't know. If I have the right one, it looks like just a high dividend fund, effectively. Doesn't show the MER in here, but I'm sure I could click into it and find it. I definitely feel like if you're a Canadian citizen, the Canadian banks right now are on a much better discount than something like this, and they have much better yield, and I feel a lot better about them. Oh, well, there's a similar discount, but I feel better about the Canadian bank stocks right now than I do about something like this, only because there's tax advantages to Canadian bank stocks, and the bank stocks are too big to fail, so literally the Canadian government would bail them out if something happened. But yeah, looking nice out. It's like snowfall, crazy here in south of Ottawa. Cool, Brandon. Here it's it's not snowing here, but it's beautiful as well. Mike, are interest going down further? So you think interest rates? No, I don't think interest rates are going down any further unless there's some new development that comes to light, or the government decides that they want to shut things down even further for longer. But no, I think things will probably hold steady. Rates today, I think, held steady with Bank of Canada. The overnight lending rate was held steady. So yeah, I don't know. I don't have a crystal ball. If I did, I would be buying options and I'd be trading on my knowledge. But again, like I don't know more than the economy does. So my prediction is that interest rates probably won't go any further. And even if they do, the banks aren't going to pass it on. So similar to what happened with the last rate hike, most of the banks didn't pass on the full 50 basis points discount to the consumer. They held the bank. So the bank has the lending rate, it's called like the bank prime. And then there's like the actual like Fed prime, right? And the bank has to follow, like when the Fed drops the rates, typically the bank will follow, but not always. In this case, the banks added a risk premium saying, hey, it's too risky for us to lend. And so effectively, they held steady, but they effectively didn't raise rates at all, or didn't drop rates at all. Walmart has it. Apparently toilet paper is made for home and business, so now everyone stays home. There's an issue, is what I read. Okay, interesting. Terry says, unactivated 0% for 6 months, MBNA card expiring in 3 days. It's just 15K Canadian. Should I use it to lend the money, for example, even if I don't have a specific other investment in view? Definitely want to activate that if it's 0%. why wouldn't you take advantage of that? You don't have to use it, at least it's there. But good point though. Like what do you do with that 15 grand if you don't have a plan for it? You'd have to have a plan for that money for sure. 0%, I guess the negatives of taking money off your credit card at 0% are, again, there's no cost, but if you were to, for instance, miss a minimum payment, they'll jump you at 20% interest. So that's something silly that I've gotten caught for before, where like it was on automatic payment, but their system was glitched and they paid it one day late and they got rid of my promotion and tried to charge me 20% interest. So look out for those things. And if you draw your credit card down all the way, the whole 15,000, it'll negatively affect your credit score quite a bit. It'll show 100% utilization on that one piece of credit, and that'll negatively affect your score by potentially 20, 30 points. So short term, it could hurt your score. If you're looking to refinance, probably not a great time to do that. But if you're not looking to refinance and put the money to work, yeah, you could go lend the money out like 10%, and I guess 10% on 15 grand is something, right? It's $1,500 over the year, so something. Hey Mike, any advice on pulling out equity during a refi? Can't pull out much as it would push the debt service ratios outside the lender's appetites. So Brian, you want to pull out as much as you possibly can because one, it is a tax write-off if you take the money and invest it somewhere else, so it's tax deductible interest. Two, it's just a better use of capital. Money stuck in your property is doing nothing for you. If you could pull that money out, you'd have the exact same appreciation amount and the exact same potentially cash flow than you had before. Maybe a little bit less cash flow because you have slight amount of interest attached to that new debt you pulled out. But again, usually that's negligible. We're talking 100, 200 bucks a month. You can take that money, pull it out of your property at say 3% or 2.5% and invest that capital. Some are making 12%, then you have a 10% spread on the money. So it's a better use of the capital if you can go put it to work. So yeah, definitely I would put it to work. As far as like the debt service ratios, you could consider getting creative with, if you have a basement apartment, you could rent it out and all of a sudden your ratios would be better if you were to rent your basement apartment out. And that would cover, if you had a lease and you actually did rent it out, then that extra income would help your ratios. A lot of lenders will at least take 50% of that rental income from your basement apartment to help offset your ratios. So that's an example of like, just get some more rental income. Or if you have a rental property, you can turn a unit over and renovate it and get the rents up, that'll help your debt service ratios, or et cetera and so forth. Just bringing in more income will help you get your debt ratios up. The other side of it too is if your debt service ratios are bad and you can't buy more properties, maybe it's because you're not buying the right properties. Maybe you have debt to pay down, or more importantly, maybe you're buying the wrong properties that barely cash flow. If your properties don't cash flow, like in Toronto and Vancouver, when you buy more rental properties, your debt service ratios get worse because there is not enough cash flow. I like to look for 2 to 3 times the mortgage payment in rental income. That ensures that after property taxes, utilities, everything, that insurance, that you have enough there to debt service for the bank. Otherwise, like if you're renting your property out at break even, the bank's gonna look at that and it's gonna be very negative debt service. It depends on the lender. So are lenders who are flexible on debt service? Yeah, there are tons of lenders. If you go to like the B lenders, they're fine. They don't even care. They don't even care at all about some B lenders and C lenders don't even care about rate. Like the 6% B lender, they don't even care about the debt service ratios near as much. Some of them are net worth based. It just depends on the lender. But you're looking at like the big 5A banks, like the A lender, they're a bit more picky as far as like debt service ratio, for sure. And like the less picky, probably, or the more picky, the better the rate you get. Nice, congrats being a guest on the McKeever Show. Right on. Hey Mike, any advice on pulling equity to that question? Next one's FutureWiz. Hey FutureWiz. Mike Rosehart, does house hacking also work in third world countries like Latin America? Yeah, I mean, house hacking works anywhere. The idea is that you just rent out portions of your house that you wouldn't otherwise be using or probably don't really need that much, and that rental income covers your living expenses. You could rent hack or house hack in any country, anywhere, as long as the law's allowed for it, I guess, or as long as you have landlord consent. Hey Mike, I just bought a 4-unit in New Brunswick. It's almost 2% rule. Been following fire. Had to use about 12K on line of credit for the down payment. Want to buy more properties. Think bank. It got cut off the rest of it. Think bank. We'll still lend. Okay. By the way, congrats. 2% rule is awesome. I don't know what the market looks like there, but that sounds like a good deal. Maybe all the properties are 2% rule, in which case it's an average deal. I don't know. But that sounds like an amazing deal. Sounds like the cash flow is fantastic. That's awesome. Using line of credit for your down payment, don't tell the bank that because they don't obviously like that. It's not something you're supposed to be able to do. But congrats, it's a great way to take down a deal. And, all of us most of us real estate investors have, used our lines of credits to take down deals for sure. So that's an awesome way to do it as far as leverage goes. As long as you have really strong cash flow, 2% rule, there's definitely positive cash flow there, so you can afford to do that. You probably got a few thousand positive cash flow each month beyond the mortgage payments and expenses, depending on the size of the property. I noticed my burn rate, and the last part of your question was, you want to have more properties? Do I think the bank will still lend? I think yes. The banks have tightened up because of COVID, so they're a bit more tense with how they've been, I guess, with the back and forth. I found with some of my refinances and stuff, they've been very conservative. But yeah, I think they'll loosen up over time. And there are still lenders out there who are taking the chance. So just go with like 6 lenders until one of them says yes. Try ratespy.com for a bunch of lenders you can grab there. But I would hit up most of the credit unions, the banks, etc., until you find someone who's willing to take the risk. I noticed my burn rate has gone down mainly because of no driving and not eating out. Have you noticed the same? Any significant drop in your burn rate? So Gabe, I didn't really do a ton of eating out before. And to be honest, I'm still eating out now, like the same as I normally do. So no, I haven't really noticed much of a difference at all as far as like burn rate, but I'm not really actively tracking my expenses like I used to. There was a time where I was like anally watching my budget and tracking that. But today, like if I spend an extra $1,000 a month, it doesn't really matter. I've got so many years of living expenses set aside, and I make so much money now that it's not as important. I'm Lux Fire, and I'm at a version of Fire. There's like Lean Fire, the regular Fire, and then there's Lux Fire. And Lux Fire is the idea that you have, I don't know what the definition was, but I heard it loosely floated once that like, I think I created the term Lux Fire. It's called Fat Fire in some of the subreddits, but I do like a frugal fire, a regular fire, and then there's like the Lux Fire, the luxury fire. I think Lux Fire is someone who aspires for more, like double or triple the average annual spend. So they want to live relatively lavish. Now they're going to be economical with how they spend their money, but they still want to live a really lavish life. They want to have the nicest things like the organic foods and the trips and all of that. And someone who's Lux Fire, I think you're not really Lux Fire until you have set aside around 75 years of Lux Fire living expenses, so to speak. So to be Lux Fire, you really need to be rich, high earner, and be wanting to spend a lot. So I don't know. It's sort of like the ultimate. Once you get to Fire, like you just want to keep going up the ladder, right? Most people get to like Lean Fire, and they're like, okay, now I want like the normal 4% rule Fire, and so they strive towards that. And then we just keep creating goals for ourselves, right? And I did the same thing. Once I reached Fire in 2017, I was like, I'm gonna make some more goals. Let's try this other goal in 2018, try another goal in 2019. Just giving ourselves a reason to push and to grow. And now it's about legacy. It's about, for me anyway, it's about legacy, and it's about just building something I can be proud of, and how can I have massive impact on the world. And part of that is with wealth, right? Like, to have a big impact on the world, you need to have either a lot of power or a lot of wealth or a level of influence, which is like power basically. So yeah, I think that with a lot of money, you can change a lot of the world and make things better. So that's one of the goals that I have, and just ensuring that future generations, from a legacy perspective, don't have to grow up how I did and scrounge sort of how I did, because I'm an anomaly. Most people who grow up in my background end up on drugs and don't end up millionaires. William says, Mike, my main sewer backed up today. $900 for the initial repair on an old house. Any way to avoid this situation again? Lessons learned from your own experience. I haven't had a ton of main sewer backups, to be honest, but there are like backup prevention tools you can put into place. You can get like a backflow preventer that would sort of stop that, which would save you quite a bit of money. But if there is like an actual clog that's caused that, one thing I've done, we did at one of our rental properties was it had roots growing through the main line going out. So we did like a root liner, or what's it called, like a pipe liner. They shoot this liner down the pipe and it clears it, and it's got like this new plastic, I think it's made of plastic liner that protects it so that it's all clean and good to go. So that's something you could do to really save yourself some money in the future. And it's like 4 or 5 grand versus digging down and putting in a new sewer line, probably like 15 grand. There are cost-effective solutions you can use. The other thing some people do too, like the super frugal folks, will just get a guy to snake their line every year for like $250. So that's always an option too. You mentioned before you should put 1/4 of your money in private equity businesses. How do you go about doing this? Any websites you recommend? So what's, it's a good question. When you don't have a lot of money and you're just getting started, the only way you can really invest in like businesses like that is through private opportunities that you find, or through like, there's websites like Lending Loop where you can lend to businesses. It's not quite the same. I'm trying to think. There's no really crowd, like if you're talking about like a public, like crowd-funded type small business equity lending, I can't think of anything in Canada that exists like that. No, I can't think of anything in Canada that exists like that. But if you had a significant enough amount of capital that you want to invest in private businesses, you could go reach out to private businesses and buy pieces of equity in their business. One of the ways is like Kijiji or Facebook, or just going to like small business for sale. Go Google and you'll find like a bunch of websites that people post businesses in. And that's basically how you find a business to invest in, or through private networking. But yeah, I think that, and what that basically is, if you can see through that, was the idea that like to be a venture capitalist, right? That's eventually one of my goals, right? One of my, like I envision for myself, this is like one of my end games would be kind of fun to do. I don't know if I'll actually go through with it, but would be have like 4 companies, right? Like one that did real estate investing for cash flow, one that was sort of just like a stock investing in like dividends, and just like capital appreciation was its sole mission for diversity, et cetera, and so forth. One that was invested in private lending, having a lending business where I was lending to flippers and lending to real estate investors, mortgages and things like that with capital. And then the 4th was just owning private businesses. So being a venture capitalist, basically, and going in and buying into off-market businesses effectively. So I think that was a cool way to have 4 cool income streams that'd be fairly diversified. And I could, if one of them ever like blew up, I have 3 other ones, each one being able to support me independently, right? So I'd be 4 times FIRE was sort of my goal. Yeah, I think if you get to a net worth perspective where you could have even 500,000 in each one, or $1 million in each one, or a couple million in each one, you'd be like super set for life. Your kids would be super set, as long as you didn't manage things too poorly. Next question. What stock market portfolio ratio should you have? It depends, but it says 25% Canada, 25% US, and 50% world. That's one asset allocation that could be fine for you. It depends on your goals. It depends on your risk tolerance. Some people, like you could talk to one person whose risk tolerance is like they are up at night if they have a 10% drop in their portfolio. And so that person shouldn't have even like a high equity split. They should be like 90% interest type debt and 10% equities, right? And then within that, their 90% equities maybe should be like 75% super blue chip, really diversified, super safe. And then it depends on like so many factors beyond like risk tolerance, beyond even like what currency do you want to spend your money in? Like, do you spend 6 months in Florida and 6 months in Canada? Do you spend 6 months in Costa Rica, 6 months in Canada? The currency in which you plan to spend in matters in how you invest your portfolio as well, because you need to be currency hedged for the currency that you actually need to get the money out of in, right? So there's so many factors that it's hard to say what is a good rate, a good percentage or ratio as far as like geography wise. And then within other sectors too, like which sectors do you want to be involved in? If you invest in like Canada, for instance, right, is super heavy natural resources, bank stocks, a little bit of tech. Like we're not very diversified. If you invest in Canada, you're missing a ton of sectors, right? We're so much naturally resource focused on our index that it's not really diversified to even just invest in like the Canada, TSX. So that's something to be cognizant of as well from a diversity perspective. There's so many different ways to slice it as far as like diversity goes, and just investing in Canada currency exposes you to the fact that we're very tied to natural resources like oil. What's happened with the oil prices, in the last couple of months has destroyed. We've watched our currency go crazy. Right, we're so tied to natural resources, and so yeah, I think that that's something to be cognizant of when you're building a portfolio. You want one that's resistant to recessions, at least to an extent, And that's important, I think, to think through how you want to diversify. Same is true with your real estate portfolio, your businesses. Think through it and decide, what makes sense for you and for your risk tolerance, et cetera, and so forth. Financial planners will do tests with you. They'll ask you questions so you can figure out, what is your risk profile, et cetera, and so forth. And if you're a conservative investor versus an aggressive one, or balanced investor, and how your asset allocations will be related to that risk profile and the type of investor, I guess, that you are. But yeah, that sounds, at surface value, that seems like a decent split, I guess. Hey fast car, fast car burr. I like that. Is that like Tracy Chapman? Are rent and house hacking bad ideas if I'm a little noise sensitive? Mr. Frugal, it depends. If you're noise sensitive, you'll want to go to the great lengths that I went to soundproof between my basement apartment. So I have 2 layers of Roxol on resilient channel, on 2 layers of 5/8 drywall, a sono panel tubing, and green glue in between the 2 sheets of drywall. And even still, I can, like, if my guys are down there playing NHL and they're screaming, I can still faintly hear them. The ducts are the worst part, like the heating system being shared. I tried to soundproof that, but didn't do a good enough job. I wrapped all the ducts in like a soundproofing 3/4 inch panel and then wrapped it all in drywall too. But even still, I have to build a sound maze inside my ducts. You can do like sound maze, so the air will still flow through around the pieces, but the noise, it will bounce and stop. So that's something I want to do to like soundproof the ducts. That's the last piece. But I got as close as I can get. Like if they're outside, I hear them better through my window. If they're outside my backyard, I would hear them better through there than I would if they're in my basement. So as an example, Mr. Frugal, for $10,000 or something, you could probably soundproof your apartment. If you did it yourself, you could do it for less. And you wouldn't have those sound transfer issues. You give them a separate entrance. It could be as almost if you don't even notice they're there. And that's the important piece, right? Is especially for myself and my family, I wanted to have that exclusivity. I don't want to have us share laundry or share anything. So it's completely separated, and it's designed to be that way, that we can be totally isolated from each other. And so that's what I'd recommend for you if you're looking to house hack or rent hack. I guess if you're rent hacking, it's sort of hard to do any of that unless you found a landlord that had already done that. But maybe a semi-detached house or something, you got both sides of it. That would be a good rent hack. But from a house hack perspective, you can design the house to live with the sound transmission so that you're actually happy with it. If you had to, let's say you're renting a room out, there's some like cheap soundproofing techniques that work pretty good. There's a sound blanket you can get. I know people use it for YouTube and stuff, but you can like hang it on the door. And then if you hung that on your bedroom door, like almost no sound gets through that at all. So you get those like soundproof blankets and get just quickly change the locks out and put like all the bedroom doors could have locks on them or something. If you're renting, right? Imagine you can't do any damage to the unit, but if you're like renting from a landlord, then that'd be something you could do to sort of separate the space and have your own space locked off. Maybe there's a way to like sort of separate the house with a lock, I don't know, between the basement and main floor if it's a rental. But yeah, I guess teach their own, and definitely you could figure out a solution. I think it's about asking, how can I make this happen, rather than saying, hey, I'm noise sensitive, so I can't do it. I like how do we make this happen? Ghost Recon, hey, how's it going? Anthony says, how much would you assume full solely cosmetic burr would cost? That question is so bad. Everything is size-based, situational-based, depends on what you're dealing with. It's impossible to say like every house costs the same, because every house costs different for renovation perspective. But like new floors, for instance, what do you want for new floors? Do you want hardwood floors? Do you want vinyl plank? Do you want laminate? Do you want carpet? Vinyl roll? What kind of flooring are you putting down? And what are you dealing with before? What kind of floor are you taking up? What does your subfloor look like? What kind of sales can you find at the Home Depot or at the Rona right now? As far as like, are you going to install the floor yourself? All these things make a huge difference. And then beyond that, even if I knew those variables, what size is the unit? Every unit's a different size. So is it 800 square feet of flooring, 700? What breakdown of each type of flooring? It's impossible for me to quote something without seeing it. And even then, it's hard to get an exact quote. Having walked through properties, it's hard to get an exact budget. I don't think I've ever been able to approximately get, precisely guess what something will cost by walking through a property. You got to sit down and crunch the numbers. You got to sit down and say, this is the floor I'm going with. And even then, like almost always, I run into something that I didn't expect. And so you're going to have a contingency budget of $5,000 or $10,000 that could creep up, right? So I wish I could just give you an answer that says like, this is what it costs. For my mentees, what I'll do is say like, this is the price for painting per hour, and a unit this size costs this much. And so they can compare that to their unit and say it's 10% bigger or smaller and get an approximation. And that's all we can do, is you can approximate cost through experience. And if you don't have that experience, you don't have those previous quotes to look at, get in 4 or 5, 2, 3, 4 contractors and compare the prices of all of them and see, then you'll have an idea of what the actual cost is. How do you find good wholesalers? Network. Michelle says, late, hi. No problem. Welcome. Are there lenders who are flexible on DSR, so debt service ratios? Yes, there are, definitely, especially B lenders. Would they use Airbnb Income if you rent out your basement? So Brennan, most lenders won't. They don't like Airbnb. Some lenders will. I've had a lender who used it before because I had consistent income. If you're doing it like for a commercial type loan, then definitely they would use that. But if you're looking for like your own primary residence, they often won't. It depends on which bank you're with, but they often won't take it. You could have like your company rent. You could set up a company, they could rent your basement and put it, and your company would put it on Airbnb, or your friend would put it on Airbnb for you. And now you're getting rent from your friend or your company, and that rent is consistent and stable, and they would count that rent. So that would be a smart way to do it if you wanted to count the rent. If I have 12K debt on a 50K line of credit, how much should I use for more deals? That depends. It's up to you. I just got into my first deal as mentioned above, and I'm considering maxing the line of credit on as many cash flowing deals I could get. So Iron Coast Capital, again, like it depends on what your goals are. Do you want to buy, if you want to buy lots of properties, you could end up maxing out your debt service ratios by taking on too much unsecured line of credit debt. You could end up by drawing that down, destroying your credit score, because now you're borrowing 100% of your available credit from that line of credit. Excuse me. And that would basically draw down your score quite a bit. So something to think about. I think it's smart to use that capital. So if you can get your down, use something else for down proof payment, then you can use your line of credit on close or something. There's lots of ideas and the ways you get creative with that line of credit, or use it for renovations. But yeah, you could definitely get more deals. There's no reason you couldn't get more deals. Mike, in 20 years' time, do you think yields in Toronto and LA will be even lower and prices even higher? It seems capital appreciation is the game there, i.e., do you see them as fairly or overvalued? William, here's the thing. The safer the investment, the lower the risk. The lower the risk, the lower the expected return. People feel that larger cities are more stable. And economically speaking, they are. But, okay, so economically speaking, they are safer. They have a better diversity of economy. It's just a fact. It's not like there's Sudbury, Ontario, where there's like no diversity at all. And like the mine shutting down destroys your real estate values, right? So what we know is that the safer the investment, the lower the expected return. Do I think that Toronto and Vancouver and LA are going to stay economic powerhouses or like very diverse, large municipalities or cities? Yes. I think that's very, very likely they will stay large or get larger. And if they stay large or get larger, then investors will expect a low return as opposed to a small town. Small towns are inevitably just inherently riskier because they don't have as many sectors, as much diversity. Their economy is smaller, right? It's like buying a penny stock versus buying a blue chip. There's a significant premium attached to buying something that's safe. So buying a house in Vancouver or Toronto or LA, it's a safe place to buy a home. It's a big municipality. It'll be there for a long time. So I think that no matter what, the returns in those big cities will be worse than it will be in small cities because the risk is less. So that is justifiably and rightfully so. And that will continue forever unless the city for some reason becomes inherently more risky. So let's say it like relied on one industry very heavily, or something happened in the city, right? That like we can't predict. I don't know, like the water supply got poisoned or something. I mean, there's definitely some weird caveats that could happen there, but by and large, from an economic standpoint, it makes sense to have a lower cap rate in the big cities, and that will continue forever. Now, is it overvalued? Depends. Depends on what you're looking for, right? It makes sense that Toronto and LA and that are more expensively priced. for the reasons I just mentioned. Are they justifiably overpriced? I don't know. It depends on certain economic indicators. You have to look at all of it. I had thought sometime a year ago that Toronto and Vancouver and LA were like 5-10% overpriced, was sort of my thought. So I thought the $1 million houses were worth like 920. That was sort of the discount that I thought would make it fair. But that means that I think in Toronto, that same house is worth 400 in London or 500 in London is worth 900 in Toronto. So it's like double the price, and that's fair because the economy is better there. It's stronger. It's inherently less risky. And so, yeah, I guess to answer your question, long term, I always see that those cities, because they are safer and perceived lower risk, will always have less cash flow and will always be an capital appreciation game. Interestingly, though, if you study the capital appreciation in these markets, some of the small towns, not small towns, but like medium-sized cities with 250,000 or 500,000 people had way better cap rates and actually appreciated at better rates than the big cities. So people were buying in Toronto and LA with no cash flow, crap cash flow, and being like, yeah, but appreciation's the best. And then their appreciation was the same as cities that were like 250,000 to 500,000 population. So they're playing the capital appreciation game and then not getting as good of a return. Like London's appreciated faster than Toronto. It's supposed to be tied to population growth and a number of other factors, but yeah, sometimes you play the appreciation game, you have no cash flow, and you still suck. Like sometimes the appreciation isn't even good as well. Like the last 5 years, London's done much better than, say, Toronto. So people who bought 5 years ago in Toronto were like, oh yeah, rah appreciation, no cash flow. Ended up with like worse appreciation and still no cash flow than they would have gotten, say, like London, as an example, right? London, Ontario, where I live and invest mostly, primarily. But yeah, anyway. Great question. So Future says, you think it is viable to buy rental property and live in a foreign country with a rental income where the cost of living is dirt cheap, like say Colombia, where there's cheap food, housing, and women? Future, I think that anything is possible. I know a guy who bought a couple of duplexes and travel all around the world. I've met lots of people who have a property manager in place and they just travel around and enjoy the cash flow. They make $1,000 a month per property. They have 3 properties, that's $3,000 a month, and they live on that income. And they've factored in the cost of their property manager, or they have a good friend or family member. They pay them a little bit of money and they take care of their property for them, or something like that, some arrangement of that sort. Yeah, totally, it's possible, definitely. Yeah, that's easy. Can you get better returns managing the property yourself? Potentially. Some people are bad managers and they're better off outsourcing. So it's something to think about. Depends on your personality, depends on a number of factors, right? But definitely, that's the idea of semi-passive real estate, is that you can, well, the beautiful thing about real estate is if you have a video tour of your property, you could post your own ads wherever you live. And you could coordinate showings. And during COVID, you can rent a unit with a virtual tour and send a lease. You could sign everything, have a digital lock that they get the passcode to, and they each transfer the rent. You could literally have someone, you could rent out a vacant unit and have them move in without physically being in the country. That's possible right now. So real estate investing, if you have a good partner on the ground, yeah, you can do it. Is it better if you're in the city? Of course. Is it better if you're closer to your properties? Of course. But do you have to be? No. If you buy the right properties and you have a good strategy and plan in place and good people to help you execute and implement, totally possible to do it that way. So will it be enough? That's up to your individual circumstances and situations, but oftentimes the answer is yes. The answer is yes, it can be enough, and it is enough. And yeah, I hope everyone's having a safe last couple of weeks at home, safe quarantine. Hopefully things are going well for you guys back at home. I wish you the best, and I'm going to wrap this stream up at the 50-minute mark, give or take here. Thank you all so much for watching. Apologies for the uneventful title and the long drawn-out Q&A today. But thank you all so much for watching. As always, the secret to unlocking a wealthier you, there's 3 levers to fire: what you spend, what you earn, and the return on your investment. So what do? To get rich or to get wealthier, we spend less, we earn more, and we maximize returns on the difference. Thanks everyone for watching. See y'all next week at 7 p.m.